You know, there's a story I love, I talk about all the time. It's the story of Ronald Read. He's a humble JCPenney janitor. He lived frugally, and he took all of his extra money, and all he did was buy stocks of household names. When he passed away at 92 years old, he had $8 million that he left behind, and he gave most of it to charity. Now, some of the stocks he invested in, American Express, Johnson & Johnson, Procter & Gamble, all are up this year. And I particularly wanted to highlight Reed's investment in McCormick. It's up 43% this year. Boring McCormick. I got to tell you, Reed, in my mind, it's a perfect example of that you don't necessarily need to buy Amazon or Apple to be a successful investor. Sometimes it's just the stuff around you. So is that what people should be doing now? Joining me now to discuss, John Lonski, Moody's chief economist, Keith Fitz-Gerald, Money Map Press chief investment strategist, and Paul Schatz, president of Heritage Capital. Hey, Paul, it's been a while. Let me start with you. You know, McCormick is up 43%. Facebook is down 22% this year. Maybe Reed had it right.
Charles, this is a great story. It's a feel-good story. It's kind of investing from your grandparents' generation. So let me just give a little of the other side. This also could be a little bit of the Beardstown Ladies Club. It really kind of sort of depends. No one on their own is going to look out and buy maybe a Caterpillar or a Deere or a Boeing, but consumer products over time have done well. They pay dividends. They're a little less volatile than the market. My 13-year-old son is doing the same thing now. He's putting together a portfolio just like Ronald Read did, but on stuff that is kind of near and dear to him. So long term, it's a wonderful strategy. I just think clearly as you have bull and bear cycles, it may become a little more challenging.
And Keith, in this particular cycle, though, where we're seeing it looks like a move out of those growth names into seeking value, you know, companies that have been around 100 years pay hefty dividends and look like they're going to be okay for the next 100 years. They're starting to work.
Oh, yeah, they certainly are, Charles. And, you know, and here's the great part. This is one of the few areas in the world where individual investors have an advantage over the institutions because they can pick their battles carefully. They can buy stocks that meet their objectives, not necessarily the objectives of a pension fund or a defined obligation. So I like this. Boring is good. Good is great returns, especially with the dividends, because you get paid for the risk you take as an owner.
You know, of course, John, we're in a go-go era right now, instant fame and celebrity, and people feel the same way about investing, too.
Yeah, that's right. But here we're looking at the stocks of consumer product companies. These companies benefit from very strong brand names. And these brand names by themselves become a barrier to entry for competitors. It's kind of hard to move in on the turf that's owned by Procter & Gamble, by McCormick. You can try, but you're probably not going to get the same margins.
So these periods where they don't have pricing power, for instance, and the names sort of lag, and you're looking at Amazon's up another 100 points. As an investor, you get a little irritated, though, right? I mean, you really have to have some serious...
There's an important lesson about high technology, and that is that it's very volatile over time. Let's go back. I think it's like maybe the 70s, 80s. I'm thinking of a company's Digital Equipment Corporation. Very strong financial company, had a very strong credit rating. It disappeared.
Right.
and
CDC is
you can
another
throw
one.
Xerox into that, too.
You could. Hey, you know what?
Xerox, Polaroid, RCA, they were all came and went.
Yeah.
Paul, but along the same theme, okay, let's talk about old tech versus new tech, right? The four horsemen, going back to the four horsemen when the whole tech phase came in. We've got them on the screen. Oracle, Microsoft, Intel, Cisco, up together cumulatively 15% on average. That's twice as much as the current four horsemen tech names, which are Amazon, Facebook, Apple, and Google Alphabet. So Paul, could the same sort of thing be applied here as well?
Yeah, in this theory of, in the Peter Lynch theory and the janitor theory and the Beardstown Ladies, oh, that didn't end up so well. You're going to find these things earlier. You're going to find the Netflix and perhaps the new branded Apple and some new kind of consumer products earlier than these large cap fund managers. And also don't forget, these are generally large cap value stocks, as Keith mentioned earlier. So right at the dot-com bubble peak, those were the cheapest in history. And I argue right now, relative to large cap growth, they're also the cheapest in history.
So do you like that? What are you looking at right now, Paul? Are you buying any? Where are you focused as an investor?
So for the last 3 months, I have pounded the table to be anti-FANG. I think the FANG bull market is essentially over. And I love large cap value. I'm not loving. I like utilities. I like staples. I like boring dividend-paying stocks. Dividend-paying stocks have been so out of vogue because the Fed's been raising rates. As soon as there's a light at the end of the tunnel, not when the Fed stops, but when there's a light or a runway to the end of the rate hike cycle, I think you'll see staples and utilities really come back into vogue.
Keith, I know you like Apple or some others, and that you could argue that's probably the cheapest stock in the market from some traditional valuation metrics. What else are you looking at?
Well, I think Apple's going to get a little cheaper before the selling's done. I think a maximum downside may even be 150. So, I know it's going to upset a lot of people in the Apple world, but, I think it's still a compelling company long term. I think Amazon's chart right now is so bad it's good. I think Nvidia was a really strong surprise to the downside, but next year after it works through a quarter or two of this, from the big tech go fast standpoint, that's great. But otherwise, it's the traditional stuff. It's the Boeings, the Raytheons in the defense sector. It's the Procter & Gamble, the J&Js. Those things are very hard to go wrong with, even if there's another downturn.
That's Ronald Read's portfolio: Raytheon, J&J, Procter & Gamble. John?
What I would say right now is the market perhaps is not going to go anywhere until we get current policy uncertainties out of the way. Number one, let's get a trade deal completed. And secondly, let's have some indication that the upside for interest rates is more limited than what the consensus and the Fed has been predicting.
That'll be the 1-2 punch, huh? That'll take us on. That's the catalyst
right there. That would take you up, yes.
Right.
And maybe we'll get that after the December 19th meeting of the FOMC. It could be a very lively final 2 weeks of the year for the equity market.
I believe so.
And look, the 10 years, I think the 10 years got to be what, at a 6-week low now, the 10-year yield? So
it's been drifting.
The long-term rates are moderating.
And I would only add to that, I'd like to see the dollar just get a little bit weaker as well, but maybe with Fed policy it will. Gentlemen, great conversation,
Thanks.
but we've run out of time. Thank you all.